Good morning. I'm Gary London, and I'm Senior Principal of London Moeder Advisors, and I have a special guest to talk about the marketplace today with me. His name is Doug Wilson, and he is the Chairman and CEO of Douglas Wilson Companies, has been for many, many years. We've been friends for many, many years and colleagues and done projects together, and we thought it would be kind of fun just to have a chat, talk about the state of the market and what we're doing strategically with our companies in terms of serving our clients and so forth. But before we start, Doug, why don't you sort of give a short bio of who you are, what you've done, and we'll take it from there.
Great. Well, good morning. And Gary, thank you for those thoughts. And I'll reinforce how we're pleased to be here. I'm very pleased. And Gary and I do go back a long, long way, probably longer than we'd like to admit. But it's been a wonderful relationship through many, many years. And through that, we have both learned about cycles and how to navigate cycles. I think that's an important key foundation. There's a little bit of background. I actually moved to San Diego in the mid 80s and developed Symphony Towers. I actually gave a speech about this morning to the Rotary Club downtown, because as a part of that $1.2 million Skidmore, Owings and Merrill mixed-use project was this elegant old theater, the Fox Theater, that we gave to the symphony and built this remarkable project around it. I was very young. I was too young to know fear, but it was a real legendary landmark here in San Diego, still is, at 1.2 million feet. Now, on a concurrent path, I'm watching all of my friends in Colorado. I'm from Chicago, went to school in Denver, however, and was in Colorado during the boom era in the late 70s. But I watched them when the energy collapsed in the 80s, how they were trying to deal with this difficult, unpredictable, and powerful economic cycle that led to a complete lack of liquidity in the economic markets. And so I had a tale of two cities, riding high here in San Diego, building the biggest project in the city with my, at 34 to 39, with my mentor partner, 13 years older, and then watching my friends go through these cycles. So many years ago in '89, I started a counter-cyclical business that was built to navigate bad markets, troubled markets, dealing with distress as a receiver, as a trustee, an advisor, and consultant, and have grown that over these 35 years and over 1,200 matters around the country, about 30 some states, about $15 billion. So, it's been an interesting and long journey, and all these cycles are different, and we find ourselves in another one today that is equally, different, a little confusing in many ways, but I think to have an opportunity to talk with you this morning, Gary, about that, about some observations and insights and how we do want to be working together on some of these assignments, I think should be it's real topical and should be of interest.
Yeah, it's so interesting. You take me back to my youth so many years ago, because we met when you were on the team developing Symphony Towers. I was on the valuation team, and I had met you at that time. And I've watched you over the years do what you do, and it's so interesting. I think our audience will be real interested in recognizing and sort of focusing on your sort of counter cycle strategy. You're a developer, and you've developed some magnificent buildings over the years. But when that cycle isn't strong, then you've put on your other hat, and you've grown your business counter-cyclically. And frankly, that's what we've done as well. When I started my company in '91, I thought we were at the beginning of the end of the recession, which had been going on for a couple of years. And the recession did end. My timing was just a little bit off by about 4 years. So I had to sort of figure out how to dig through, a bad cycle. And like you, we figured out counter-cyclical strategies and how to service clients in tough times. And those, frankly, are the most rewarding kind of assignments we've had over the years, aren't they?
They really are. And to kind of lay a little backdrop or foundation to the discussion, when I realized that cycles were immediately powerful and impactful on liquidity and real estate, and how do you make money in bad times, had a good lawyer, a friend, explain a remedy under a defaulted deed of trust to put in a court-appointed receiver as a non-party, as a non-partial fiduciary working on behalf of the court to take over broken problem deals. As we grew that, as you did your business through those early 90s with the RTC days and our timing is pretty damn good.
Right.
And I was realizing that the capital wasn't just here in San Diego. So I would go to New York, and I started at that time going what wound up to be over nearly 30 years, 5-6 times a year, in developing strong institutional national relationships. So that has really allowed us to, between those relationships with capital providers, those could be banks, both large and regional, pension funds, life companies, private equity firms, the Wall Street banks, private funds as it is today, and the lawyers that work in that sector. It's given us a wealth of opportunity and exposure to every conceivable issue. All of these have been challenging. We're a bit of a canary in the coal mine when there's shifts in the market, and I know you are as well. And so, yes, it's been an interesting experience. It's been, frankly, a very rewarding experience, because people say, well, aren't you proud of this nearly $1 billion in today's value, these projects you built downtown? And I am. We're immensely proud of that. But I'm more proud of the fact that we're able to craft a business model that was able to navigate over these ensuing decades.
Before we get into the market, and I want to take a deep dive into that for sure. Tell us a little bit about your team. Who do you have around you, and sort of what are the skill sets?
Well, so, it's, even though my name be on the door, the reality is I've always surrounded myself with very smart, capable people. I often jokingly say, I've never had a business class, which is true. And I recognized many years ago, so what do? You hire people that know what you don't know and give them the authority and the leadership to do their job. I think we as a company have been known to be entrepreneurial, but very institutional in our profile. And to do that, I've had to get some of the best and the brightest. We have a team today that we've really put in place carefully over the last 5 years to really carry this business model forward in our 35, 40-year legacy, led by Michelle Vivas, who is the president of the firm, been with us about 10 years, well known to you, Gary, a CFO and a controller, both female, both CPAs, incredibly, one with a real forensic background, and then some really strong project people, not all here in San Diego, in other markets as well. And so, again, I think good leaders understand the need to have wonderful people, giving them the opportunity to assert themselves and not to second guess them.
Good. Well, listen, you and I have had a number of discussions over the past year, really, as to what the state of the market is. And a lot of that discussion has focused around the commercial office sector, which I think we both believe and are seeing the play out now is the most difficult real estate food group right now that we're facing with respect to current high vacancy rates, the prospect that those vacancy rates are going to stay high, lease rates are going to drop, valuations are going to drop. All this as a result, and we've sort of, Doug, we've characterized this, we've documented this in previous videos that we've done, but just to sort of put a summary on it, the markets are in a very difficult place right now. The office market, that is, around the nation. You can sort of pick your poison. It doesn't really matter whether we're talking about downtown San Diego or New York or Chicago or Atlanta or San Francisco, LA. Everybody's sort of in the same place as a result of long-term evolution in terms of how much the amount of office space we need, and a compression in terms of the demand for that office space. But the revolution that happened during the pandemic, when people went home and many didn't come back, and now we're sort of in that mode where many companies are trying to figure out how they're going to adapt to an environment where this idea of working at home has been very sticky. People, particularly, we're not talking about people on the front lines. We're talking about basically professional services people, accountants, attorneys, consultants, anybody who works in an office. They're grappling with this idea of, how do we get people in the office? Terms like flex space are often bandied about, but obviously there's going to be failures in the marketplace, aren't there?
There's no question. I mean, this has been, I call it a bit of a slow moving train wreck, because, all the pieces, and we could talk about that later, have really been leading up to this over these last many, many years, with, the long-term low interest rates and cost of capital, the amount of liquidity that flooded the markets, the pandemic and the era of forbearance, and then the reality of cost increases that have impacted everybody, not just here, but around the world. and the rates that had to go up in order to counterbalance that. So we are now at this vortex. It's a really strange place because we have this economic issues that are now on a parallel path with all the uses issues that you were talking about. And right now there's so many people studying, what is it going to do? Can you convert to residential? Not really, maybe some. I mean, some you can, obviously, but not a vast amount. So what other solutions? Flex office, repurposing. All of these are high points of discussion, all at a point when we have so many loans coming due. I mean, well in excess of $1 trillion over the next few years. And, with replacement financing that would be, 2 or 3-fold as expensive as what is currently in place. So, it's just a bad dynamic at this point, but it is playing out in a slow motion way. I mean, do you see that as well, Gary, and how your observations are?
Oh, absolutely. And in my world, which is sort of the economic dirt kicking world, we're doing reuse studies already at this early stage on high-rise office buildings that the owners have already declared, partially through our analysis, don't have a future as office buildings. So we're looking at conversion. In one particular project, we're looking at conversion to residential, doing the market studies, running various financial pro formas and so forth to determine what that solution is. And the solutions remain elusive, but as the economic base of these assets go down, we're going to see more and more opportunities, positive opportunities for a lot of these assets. So I guess this would be a good point to talk about sort of the intersection between these market dynamics and what you do for your clients at this point. At what point do you sort of do you get that phone call? Do you insert yourself into the process of recovering an asset that really can't live in the future the way it lived in the past?
So, to clarify the role that we have, when I learned many, many years ago, when a developer is in trouble and they're out of liquidity, they no longer have equity in their building, they're not going to be hiring us to tell them how to fix their problem. The fact of the matter is, we're much more on the creditor side, where we have people, either partnership issues or disputes, or people that may have lent money either as a first trustee position or mezz position or other positions, where they've got a defaulted loan, they've got an upside down project, and so we, at that point, to your point, oftentimes the quote owner developers quote out of the money. They no longer have any equity in the project. They no longer have any economic incentive. Therefore, they really don't have a motivation to stay on board. And therefore, they want to hand the keys, quote, back to the lender. In a variation of those fact patterns, we often get called by either the lender and or their advisors. They can be legal advisors, most typically, the lawyers, to be considered as a receiver, which is a court-appointed fiduciary working typically in state court, can't be federal, where you go in under a carefully crafted order that delineates what the responsibilities would be to either step in and take over the operations, hire the appropriate property management, leasing, asset management, whatever is required for that project. It can be as simple as collecting the rents and making sure insurance is paid, to as complicated as completing a half-built building, as we have done on a number of occasions, most prominently on behalf of the Bank of America back east some years ago on a large project. So, what happens? So when I mentioned earlier, we're a canary in the coal mine. When there is stress percolating to the surface, we often get called as saying, get ready, we may have an opportunity for you. If so, you've got to step in quickly and efficiently, and to do so in a manner that is minimally disruptive to the collateral. Because the real fundamental role is preservation of the collateral. One last point that you mentioned that I find very timely and interesting is the basis in some of these buildings, Gary. I'm doing a ULI presentation here in a few weeks. In preparation for that, we're discussing a lot of these issues. And I noted some of these sales are what are in the market, specifically in Los Angeles in the last year. And these price points, where you've got some of these major towers trading for, $120, $140 a square foot. At those levels, that whole notion of what it's going to be in the future, becomes, you got to be creative.
Yeah.
Anyway.
It's interesting. And, I just went to a discussion yesterday where they repeated, some of the panelists repeated this mantra that only a very small percentage of buildings are convertible. And I just have to tell you, I don't buy that at all. I think as we sort of go down to these lower economics, anything's convertible if it makes financial sense. See, there's no limitations in terms of the physical layout of buildings. Obviously, many of the older buildings that are going to be in trouble or are in trouble have smaller floor layouts and that sort of thing. But I think that, of the options, either just bring the office lease rates down to a level where, some economics can be supported. Demolish the building is the second strategy, and usually not the best one or the electable one. And then the third one is conversion, or at least some kind of conversion where you have less office space, maybe residential, maybe hotel, maybe you transform into mixed use projects. And I think that going forward, a lot of these kinds of solutions that you and I are going to be looking at are going to be those solutions where we find really new opportunities. So I guess what I'm really trying to say is, I don't want to sort of portray this discussion as being a negative one. I think that out of the turmoil and tumult that we're facing today, we're going to see a lot of opportunities in the real estate sector. It's just going to take some time to play out, isn't it?
Well, I learned years ago, I had a very wise man tell me 35 years ago, you're best to buy your straw hats in the winter.
Yeah.
In other words, if you can control assets, and Sam Zell built a business around this, at the right time to get in at a lower basis, your opportunities become limitless. I have a long-term belief in commercial real estate on all levels, residential as well. But to have a periodic reset, which we're now having and is going to continue for a while, is probably healthy in the long term, because you get to repurpose these assets into what are the opportunities for the future. What is the future use? I mean, we're seeing a lot of, some of these hotels that haven't been performing converted to residential. They're pretty easily adaptable because they've got the plumbing and they're kind of electrical and they're set up for some of that. But I agree with you. I think that, look, I mean, there's distress, there's blood in the water. People are losing money. We understand all that. But longer term, for those that have a long-term view and are creative and entrepreneurial, there's lots of opportunity. It always is.
I think that, just to piggyback on what you're saying, I think that the way to measure success in real estate is how to buy it right. When you sell it, that's when you make the money, but that's sort of more like an accounting thing, isn't it? That's the gain. The decisions that are made at the point of acquisition are the decisions that are actually making you money. And this is sort of the strategic approach that you mentioned, Sam Zell. That's may he rest in peace. That Sam Zell adopted. He was known as the grave dancer because he came in at times like these and he purchased properties at their lowest base. So I think for our audience, this is really a key message. This is the time to go after real estate and to look at it. And that window is not going to be short. I mean, we're looking really at the next couple of years. This is, as you said earlier, this is a slow-moving train. But the reality is that you do buy straw hats in the winter. By the way, that's a Bernard Baruch quote, I think, from the 1930s. So someone was plagiarizing that when they told you that earlier, but it is accurate. And I think
they told me they made it up.
So you just want to, that's just another person on your checklist that you don't want to trust. But I think really that this is the time where opportunities do present themselves in distressed points of the sector. And we've been focusing on commercial office because that's by far the most distressed point. But, to some extent, obviously, commercial retail has been a focus of our attention as well in terms of conversion, adaptive reuse, and that sort of thing. So, there's a big space right now where you and I come in and we evaluate these opportunities on behalf of our clients, whoever they might be, and we help them work out a way to create prosperity out of these.
Now, there are a few observations that are quite different. And all these cycles are different, but we don't have the leverage that we had, prior to the Great Recession. We understand that, okay? But all the fundamental costs and the underlying increase in interest rates has been higher in a short period of time than we've also seen in 40 years. Also, the fact is that after the Great Recession, because of Dodd-Frank, a lot of banks were not even lending. So a lot of funds were created. very sophisticated ones, Starwood, Blackstone, and others. But everybody created a fund at every level. So the point is, there was so much liquidity that flooded these markets. And, much of it was, trying to survive at a time, or was frothy, to creating this frothy environment at a time when interest rates were so low and cap rates were at levels we had never seen before. But now we're in this great adjustment. But that having been said, there's still parked so much liquidity wanting to step back into these markets. We've never really seen that. So the point is, there's a lot of competition for that distressed pool. And at this point, the distressed pool is not that large, but it's growing and will grow, we think, significantly over the next 24 months. But that's why I call it not just a slow-moving train, but a slow-moving train wreck.
Right. And I want to emphasize that it's across several sectors. I mean, it's across the sector, it's across the retail sector, it's across the apartment sector, maybe not here on the West Coast, but as you go inland into other markets where they've built significant apartment inventory built at low interest rates, as the interest rates have increased in this Fed effort to fight inflation. A lot of those deals are very distressed right now. You're probably going to see them fall in your lap in some cases, aren't you?
Well, we are. And so, the calls we get, obviously office is one, large retail is others. Partially built buildings is something we're seeing more of, where, they were underwritten at a basis that is no longer applicable. They don't really have the cost to complete some of these projects. Yeah. And therefore the lender or the borrower, again, is, quote, out of the money. And so to step in and not necessarily to complete the building, but at least to preserve entitlements, preserve permits, to make sure that, there's some value there, so that we could sell some of these assets through a receivership sale, which is a commonly used mechanism approved by the court system, similar to a bankruptcy sale. So others can come in at a lower basis, fix what's there, underwrite them according to today's standard, and move forward with the process. So that's what makes this business for both of us so interesting. You never know what you're going to see. I mean, we see every conceivable type of real estate, be it land, partially built buildings. We've done ski resorts, golf courses. It's all over the place. But right now, the top of mind is the office sector, but I think it is systemic in the commercial real estate sector, including multifamily. More in some markets. Clearly.
Yeah. Let's turn for a minute. Let's talk about what we're doing together.
Yes.
What you and I have been talking about our strategic alliance for some time, and we've actually done this together, where you call us in or we call you in, but we come in and we do what we do, which is the economic studies, the financial studies, and so forth, to help to create a strategy of what to do with these assets. And then we do a TO to you, and you implement this. You consult on the strategy, and then you implement on the strategy. So maybe you sort of could talk a little bit more about that.
Well, so yeah, I mean, we're actually highly compatible and have been and will continue to be. So the fact is, the perspective we bring is that we've been there, done that. I've actually built buildings. I've signed these loans, recourse loans. I've walked the walk. I've been there. Just didn't, I'm not a consultant purely to do that. Been there, done that, been through that. I've also taken over every conceivable broken deal as a fiduciary, as a receiver. So two things. We have a wealth of experience, and how we behave, the bar is very high. We're not just a predatory real estate firm. That having been said, so we come in dealing with perceiving things as an owner might, and how do we best get through this issue, these challenges, craft a business plan for the future. In order to do that, we've got to deal with partners like you that can do a lot of the blocking and tackling and underwriting and economic analysis that, as you and I well know, is but for a market, nothing ever gets built in real estate. And so you always need, a thoughtful document that reinforces what you want to be doing, what that repositioning might be. And so recently, we were involved in a project here in San Diego on a large project in Mission Valley, a centrally located area, an owner of a current hospitality project that's quite dated, had a lot of deed restrictions, other issues, and that area, which is a lot of growth, had gone through an updated community plan. Michelle Vivas, the president of my company, is uniquely suited to deal with projects like that, who you and I know your partner Nathan have dealt with a lot. And we brought you in as a team member, shoulder to shoulder with us to work on behalf of, in that case, a family, a prominent family that owned the project. But no lender was involved. It was because we both do work with families, legacy families, handing down real estate to multiple generations. And at the end of the day, it was a completely collaborative adventure. And at the end, we had a very happy client. Now, the market turned, we can't control that, but they're still long-term, they're going to be in a very positive place. So, I think that's a great example.
Yeah, I do too. And I think that, again, regardless of what kind of asset we're talking about, the services that both of our companies provide are not only are they needed, but they're compatible. And I think we're going to see a lot more of our work together in the strategic alliance going forward over the coming years. And I think that the emphasis here again is that what distinguishes real estate from other assets is that you call it a slow-moving train. I call it, real estate just moves we measure it and it moves at a snail's pace. We measure it in terms of not even months, but quarters and years and decades. And in other asset classes, like securities, we measure it in seconds, minutes, and hours. And so you and I have developed sort of a long-term approach to these things. And we recognize that because of the inefficiencies of the capitalist system, we have these real estate cycles. I mean, I think you and I have been through 5 or 6 of these cycles over our careers. And the good news is we're still vertical. We're still standing up and talking about them, because out of every negative experience, a positive experience comes from it. And, essentially that's the theme of what we're talking about today, is the fact that, there'll be winners and losers, but we try to take what are today perceived as the losers and turn them into winners going forward, because the cycle will change positive.
Right.
So I think that if people need to reach you, maybe you should just offer up your contact information. This would be a good time to do that.
Well, if they need to reach me directly, our website is douglaswilson.com. And we have a very extensive website with a lot of information on it that I think people would find of interest. My personal email is simple. It's just dwilson@douglaswilson.com. That's the easiest way to reach me. Telephonically, it's just by phone, it's just 619-641-1141. And I'll get back to you, or Michelle will. But those are the simplest ways to reach out to us.
All right. Well, it's been a pleasure to have this chat. Doug, anything else you want to say?
No, except that I appreciate very much being asked to participate in this. I find these discussions very worthwhile. It's important to be able to have candid discussions about these situations, and they don't have to be, seated in, awfulness. There is, you will persevere. Strength comes out of challenges. And I've always believed that. I've built a career on that. And I always think that opportunities will percolate to the surface. And to be able to have an opportunity at this point in our development as a business to work with partners like you is an honor. So.
Well, I too value this relationship, and I very much enjoyed our relationship over the decades. And I hope we have a few more decades to do this together.
Thank you.
All right, Doug. Thanks again.
See ya.
All right.
Good. Thanks so much. Bye-bye.
Bye-bye.